Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name's Steve Brice and I'm Standard Chartered Bank's Global Chief Investment Officer. Welcome to our second instalment of the special series where we talk about the outlook for financial markets in 2025 with different members of the CIO office here at Standard Chartered. Today I'm talking to Rajat Bhattacharya, who runs our economics team, to discuss our global economic outlook as well as the outlook for some key currencies. So, Rajat, let's get straight to it. So, obviously, global economic growth has been stabilizing just above 3%. However, underneath the surface, the US economy has been increasingly important from a global growth perspective, while Euro area and emerging markets, including China and India, actually, have been slowing. So, against this backdrop, what's the macroeconomic outlook for next year?
Hi, Steve. That's indeed true. And we don't expect the drivers of growth to change a lot in 2025. In a nutshell, if I may, we still expect US to drive growth in the coming year unless we see signs of significant, and I really mean significant fiscal policy easing in Europe and or in China. In fact, US economic expansion is likely to get a further boost following Trump's election win. We see a 40% chance of a no landing and 45% chance of a soft landing in the next 12 months, compared with 15% and 60% respectively before the US elections. Trump's win has boosted US business confidence on expectations of tax cuts and deregulation and increased protectionism from tariffs. While tariffs and marginal tightening of the job market due to immigration curbs are likely to initially keep inflation elevated, plans to boost US energy output should help lower energy costs and, in turn, inflation expectations. We expect the Fed to look through any tariff related lift to inflation and eventually cut rates by another 100 basis points over the next 12 months, including at 25 basis points later this week. Now, the outlook for the rest of the world is more uncertain. Europe, China, Mexico, and Canada face increased trade uncertainty as Trump imposes higher import tariffs as a starting point of negotiations to bring down the US trade deficit with the two economies. China, facing deflationary pressures, is likely to try and offset US import curbs with higher exports to non US markets and increased stimulus to boost domestic demand. The euro area faces a greater challenge given self imposed constraints to expanding fiscal policy.
Okay, so let's look at the US economic outlook a bit more closely. You sort of hinted at the implications that we're going to have from the new president and the Republicans obviously taking power then from January. So, what are the implications of Trump's victory for the US economy next year?
Yes, Trump's return to power with a popular mandate in the US election is likely to lead to far reaching changes in the US and global economic and geopolitical landscape. We see Trump's pro growth policies focused on tax cuts, deregulation, and protectionism, lifting US business confidence and private investment, potentially sustaining above trend growth longer in the US. The impact on inflation, I must say, remains uncertain. Trump's choice of Scott Bessent, a career fund manager, as the Treasury Secretary has reassured markets for now, given his business friendly, pro growth, non inflationary proposals. Our base case is that import tariffs would be implemented in phases. However, we will need to watch inflation expectations closely. A sustained rise in those expectations would slow the pace of Fed rate cuts and lead to reassessment of his policies.
So you alluded to Bessent's, as being the Treasury Secretary nomination, right? So what should we look for from him from a tax perspective? Is he going to be pushing through some more tax cuts?
Yes, we think that Bessent's foremost task would be to ensure that the personal tax cuts implemented during Trump's previous presidency and which are due to expire next year, are extended as soon as possible. Besant's challenge would be finding new revenue sources and spending cuts to pay for the tax cuts, while lowering the budget deficit. Now, Besant has already proposed cutting the budget deficit to 3% by the end of Trump's 4 year term from more than 6% today. The Republican Party's thin majority in the House of Representatives would make it challenging to pass any ambitious tax cuts, I must say, through a special reconciliation bill in the Congress. Our base case is that administration will extend the prior tax cuts, perhaps with a few other election promises such as ending taxes on tips and gratuities, enacting more ambitious measures such as exempting social security from taxes or significantly cutting corporate taxes further would raise concerns about the budget deficit and lead to a surge in bond yields, something that the administration would try to avoid.
Okay, so I guess we've covered some of the positive aspects in terms of potential, for at least from a stock market perspective, of potential tax cuts or extension of existing cuts. I guess there's always this thing on the other side of that is Trump's tariff plans, right? So, do you sense that Trump will issue executive orders to impose stiff tariffs on major trade partners as soon as he takes charge on the 20th of January? Um, Obviously, that's part of that might be to fund those tax cuts you talked about as well. So, what is your sense here?
Yes, tariffs is a big question mark, and what Trump has done is already notified key trade partners such as China, Canada, and Mexico of his plans to impose stiff import tariffs. It remains to be seen whether the threat of tariffs is a negotiating tool to achieve his objective of attracting manufacturing investment into the US, or is it advance notice given to the trade partners of building walls, at least temporarily, to protect domestic industry against imports and reduce the trade deficit? Now, while Besant's nomination as Treasury Secretary suggests Trump wants to use tariffs as a means to an end, Trump's cabinet consists of trade hawks who see tariffs as an end in itself to rebalance US economic drivers and the pattern of global trade. How key trade partners such as China and Europe react to those tariffs, given their own internal economic and political challenges, is another key question. It's worth noting here that Trump plans to use import tariffs to pay off for almost quarter of the proposed tax cuts and increase spending. How Trump and Besant manage the seemingly divergent pulls and pressures in the coming months to reduce the budget deficit will be something markets will watch very closely.
Okay, so I guess you sound relatively upbeat on the economic picture. Obviously, markets are definitely optimistic. Can you give me a sense of what the risks are to to this positive outlook?
Sure, actually, we assign a 15% probability of a US recession over the next 12 months. Now, that sounds low, but we say that because the leading index of 10 key forward looking indicators that the market has been watching for years, for decades, is signaling elevated risk of a downturn. Forward looking labor market indicators, such as the job vacancy rate, are pointing to a rise in unemployment. Government sector jobs that have been propping up the payrolls this year are likely to drop under a Trump administration. Will a rebound in private sector employment pick up the slack? Is a key question out there. Then there is the risk of higher inflation, at least in the near term, from some of Trump's policies.
Okay, let's move to the euro area. Do you expect a recovery anytime next year?
The euro area, arguably, Steve, faces the biggest challenges of all the major regions from a Trump administration. And why we say that? A universal tariff on all US imports would impact the region hard, given the US is by far the euro area's largest export market. The region's self imposed fiscal constraints leave it at a disadvantage, especially compared with China. Political uncertainty in Germany following the collapse of the governing coalition and a minority government in France add to the uncertainty. As the challenges mount and business confidence wanes, we expect the ECB to cut rates by about 125 basis points over the next year. Now, the US led shock could be a catalyst for the European region to ease its fiscal spending rules. The snap election in Germany, scheduled for February, is likely to bring a new coalition to power, which could be more forthcoming in easing Germany's fiscal policy rules.
Okay, so from an economics perspective, before we move on to FX, what about China? You're expecting more policy stimulus from China?
Yes, we are, but the timing is critical here. So, China's policymakers have unveiled a series of fiscal and monetary policy easing measures aimed at reviving the property market, easing local government debt, and overcoming deflationary pressures. We expect further fiscal easing once Beijing assesses the Trump administration's policies. While Trump has proposed imposing tariffs as high as 60% on imports from China, we believe they will be implemented in phases and not all at once, and will be linked to quid pro quo deals such as boosting imports from the US. Last time they boosted US boosted exports of airplanes, for instance, or farm products, and then increasing manufacturing investment in the US. China significantly reduced its exports to the US in recent years, making it less vulnerable to US protectionist policies versus, let's say, Europe.
Okay, so let's look at FX now. So, what does all this mean for the US dollar?
Now we expect a range-bound dollar over the next 12 months because dollar has already risen before and after Trump's election. Now we do have a slightly bullish bias over the next 3 months. The main drivers likely to shape the dollar's outlook in 2025 are: one, potential US tax policy, as I mentioned. Second is that critical tariff policy and global trade dynamics. And third, the differential between the Fed and ECB rates. Now, policy expectations from Trump's election win and higher US bond yields have pushed the dollar higher in recent months, and we expect it to modestly rise further over the next 1 to 3 months. Trump's nomination of Bessent as Treasury Secretary, however, argues his non inflationary growth agenda is likely to help partly offset Trump's more inflationary trade and immigration policies, leaving the greenback range bound over the longer term. G10 central banks are in a rate cutting cycle, and range bound interest rate differentials also support a broadly range bound dollar in 2025, albeit with potentially higher volatility than we saw this year. Higher than expected inflation and Fed rates are an upside risk, while policies to actively weaken the dollar, such as speculation on a new Plaza Accord style agreement, is a downside risk.
Okay, and just to wrap up, then let's look at other currencies around the world. Any divergences you're expecting between currencies outside of the US?
Yes, we do see the British pound and the Japanese yen as likely the main ones to benefit, and, albeit modestly, while the dollar consolidates next year. Despite an easing of UK manufacturing and services sector, stable wage growth is likely to lift real incomes and consumer demand. Meanwhile, Japan's steady service sector inflation and wage growth should bolster the case for further Bank of Japan rate hikes through 2025. As a result, dollar yen is likely to move lower on narrowing rate differentials. Commodity currencies such as Australian dollar, New Zealand dollar, and the Canadian dollar are likely to consolidate after recent losses on a 3 month horizon. However, weak terms of trade, by that I mean the ratio between their export and import prices, which peaked in 2022, mean that any further significant upside in these commodity currencies is unlikely over the 12 months.
Okay, well, thank you, Rajat, for that. That's all we have time for today. And thank you, listener, for joining us as well. Please look out for the next installment of this mini series when I'll be talking to Raymond Cheng about the outlook for global equity markets. In the meantime, thanks again and take care. Please have a fantastic rest of your day.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.